Hi everyone, welcome to a new episode of Conversa de Fundos, and today we have a very special guest here with us, Robert Lee. He is responsible for the investor relations of PAX, Patria's Nasdaq listed stock, and he's going to share a little bit of his view on the private markets industry with us. Rob, first of all, thank you for accepting our invitation, and I hope all is well. How are you doing?
I'm doing great, and thank you so much for having me here. I'm looking forward to it.
Good. So I spoke briefly about your role here at Patria, but it would be great if you could share with us a bit of your career development, the industries you worked for, and how you've seen the markets development during those times.
Sure. So I was a investment research analyst on what's called the sell side for 30 years. And I focused on covering the asset management industry over that time, and some other financial services companies too, out of New York, where I live. And it's been interesting because over that 30 years, I got to see the evolution and development of the asset management industry from, I'm going to call it its early days to what it is today, and seeing how the different types of companies have gone public, evolved over time. So it's been a very interesting journey. I did actually retire 2 years ago after doing that for a long time, and did some consulting work for some companies in the industry, including Patria. And then about 4 months ago, I got a call from the company, and they coaxed me out of retirement to come take on this role.
It was an interesting challenge, right?
It was a good challenge.
Yeah.
Looking forward to it, and it's been great. And so here I am, on this exciting next part of my journey in my career.
Yeah, good to have you here.
It's great to be here.
Yeah. And with your extensive experience in this market, you've seen how the private markets evolved with the appetite from institutional investors and now expanding the industry, becoming more interesting for individuals in the US. Can you tell a bit more about this and how you've seen it?
Well, I think it's been interesting because starting with the institutional part of the business, maybe, or even going back further than that, it's seeing the evolution from in the early days. It was investors buying traditional stock and bond portfolios, individuals doing that, institutions doing that. And then over time, what you've seen is as markets have grown, as the assets that these investors have or own has grown, the evolution has been towards, we need other places to source returns, okay? And for different reasons, which would probably worth another podcast, one of the places they've looked to source those returns are in private markets. And I think what's interesting is a lot of investors don't really appreciate this size of the private markets. When people think of investing, they think of the stock exchange or buying bonds.
Because it's more visible, right?
It's more visible. It's in the paper every day. You read about it. But if you think of what I would call private assets, think of the building you work in, the roads you travel on.
The lights.
The cameras. There's many more assets in private businesses or private assets that were not previously accessible or that accessible to institutional investors, or individual investors. So the evolution of this alternative investing, if you will, has really been about how do you access the private markets to find excess returns, as returns maybe in public markets have been insufficient or too risky or too volatile, and as the amount of money that these institutions globally have, if you think of the size of some sovereign wealth funds, for example, they need to find other places to put that money.
With scale at very large numbers. Yeah. So you've had this development of investing in private assets, which everyone calls alternative assets. Yeah, another name.
Yeah, right. So it's been interesting to see that evolution over time.
Yeah, and we were talking about like how the industry of listed asset managers, how it developed during the years. This is very interesting to note also. How you see the scene of listed asset managers on the private markets and traditional asset managers and ETF asset managers?
Well, that's been one of the most fascinating evolutions over my long career. So when I started my career, you had a couple of traditional managers. I don't know if anyone's familiar with a firm like BlackRock or whatnot, and ETFs were not a thing back then. And they grew up from being very small, kind of narrowly focused businesses to being, in some cases, very large, global, broad businesses. I mean, BlackRock went from zero, when I actually first started to know them, to managing over 10 trillion US dollars today.
They are very well established in Brazil also.
Right, so it's been fascinating to see that, but the nature of their product line has changed. Then if I think of the alternative managers, one of the first companies to go public was Blackstone. There is actually a relationship there between the two of them, but we don't need to go into that either. But when they went public, they had 70 billion, roughly, of assets under management. And if you look at them today, they are bumping up against $1 trillion.
Yeah.
And the business is much more diverse, does many more things, more global than it used to be. And they've matured and grown in order to serve this growing demand for these private assets and alternative investing.
Yeah, and now those firms like on the private markets, they are a target. They have made their name with the institutional investors. It's a proven way of getting return adjusted to risk returns.
Yes.
And now they are looking with more attention to individuals in developed markets. And which do you think are the most important challenges for the reach out of this public?
Well, it's maybe touching a little background on that first. I think we have an exhibit that shows the expected growth rates of demand for institutional investors in alternatives and individual investors in alternatives, and you can see that it's very high for both, but it's particularly high for individuals, and that's partially because the market share, if you will, or the amount of their assets that individual investors have in alternatives is still very small. Okay, there's another exhibit here that shows you the comparative, how much of the assets that individuals have versus institutions invest in these markets, and you can see that it's tiny. And that's the opportunity, but to the question, one of the challenges has been that it's a different world than selling or marketing or managing assets for institutions. It's much more highly fragmented.
Yeah.
How you distribute or get those strategies to individuals is very different.
Through intermediaries.
Through intermediaries.
Which are still learning from the process and from the asset. Yeah.
And there's a learning curve that the intermediaries have to go through. There's a learning curve that the individuals have to go through.
Yeah.
The product structures have to be different. Because many institutions, when think of a pension that has a multi-decade life. Think of a sovereign wealth fund. They have a multi-decade life. So they can invest with a time frame of 10, 20, 30 years or longer in some cases. Individuals tend not to have, even if they're young, don't tend to think quite as long.
Yeah.
And then as they age, your investment horizons tend to shrink too. So, and also individuals prize, and it's important, prize liquidity more so than institutions. Institutions, liquidity, being able to buy or sell the asset, on short notice is very important for all investors, but probably more so for individuals.
Yeah.
And one of the challenges is if you're investing in private assets, you have to be able to have that money locked up for a long period of time.
Yeah, the liquidity premium.
Right. If you're buying an office building, right, and you're using money to buy it that could be pulled back the next day, you're going to have a problem if people pull back their money the next day.
Yeah.
You have to have money that cash that's stable will be there.
And there's a value for this.
And there's a value for that. So one of the challenges for bringing alternative products to individual investors is matching that duration of the investment to the duration of the assets and being able to give them liquidity. So there's a product structure that have to be figured out, which they are in the U.S., and we could talk about that. Then it's also more heavily regulated. So there's a lot of challenges to getting it to the individual versus the institution. But in the U.S., they've made steady progress at working towards this, and you're starting to see much more uptake, although early days, of marketing alternative investments to individual investors.
Yeah. Something interesting to touch on this topic is the ability of this market to design customized solutions, which was one of the features that got the institutional investors very interested on the solutions. And now how the industry is shaping itself to offer solutions that attack those necessities of individuals, like semi-liquid structures. Can we talk a little bit about this, the customization?
Sure. It's probably a little less about that you're customizing, well, you're creating new structures for individual investors. So if you think of in the US, a traditional mutual fund, you're commingling different investors, but everyone can take their money out the next day if they choose to.
Yeah.
Okay. What they are creating are these semi-liquid products, which is you're still commingling your assets with other individual investors, but your ability to take your money out is limited. So different products have different structures. Some may be you're limited to 5% of your assets every quarter or something. So there's different structures.
The loved and hated gates.
Yes, the loved and hated gates. And that is it's needed on these products because, again, you're investing in assets that aren't readily liquid. One of the advantages of that alternative managers have is that they are investing with this locked up capital. So it allows them to do more complex things, to invest in more complex assets, to create more customized solutions, to invest with a very long investment horizon. You can't do that if the money can be pulled out quickly.
Yeah.
So these hybrid structures are trying to bridge that gap for individual investors.
Yeah, good. And Rob, which do you think are the key trends in this market, and how is Patria positioned on those?
So I think the key trend is, well, if we think of the key trend in terms of what types of strategies are investors buying, there's always high demand for things that have an attractive yield.
Yeah.
So in the U.S., the private asset alternative products that retail has tended to gravitate towards tend to be products that have an attractive yield. So they tend to be private credit-oriented products. Now, that can range from a lot of different things. That could be products that invest in real estate from a credit perspective. It could be products that invest predominantly in buyouts from private markets. Yeah. It could be customized solutions. It could be infrastructure. So there's a lot of different underlying strategies, but they often have a yield and distribution component to them. Second after that is starting to see more, and this is still very early days, starting to see more products and interest in things that can invest in infrastructure, for example. So it may not have as much of a yield component to it, maybe more growth-oriented.
Inflation protected.
Which
is a topic nowadays, right?
Yes,
nowadays.
Very much so. So you're starting to see more demand for those. There's also what is called solutions products, which invest in what are called co-investments and secondaries, different types of private equity, different types of infrastructure investing, but more of a total return or growth orientation to the investments. So it's still very early days. If I think of where Patria is within that mix,
We are on all of those.
All of those, but it's still early days.
Yeah.
So if you think about it, the company has really only been public for 3.5 years, just about.
It seems more.
It seems more, I guess. And when Patria went public, we had the private equity and infrastructure business, which is great.
Yeah.
But that was basically 2 products. If you think of the firm today, we have over 30 products.
Yeah.
Over 40 billion of assets under management compared to 7 or 8 when we went public. We didn't have the REIT business in Brazil where we do now. I think it's about 6 billion of assets. We didn't have the same credit business. So it's still early days, but I think what the firm has worked hard to do through acquisitions and organically is to build that product set and those capabilities, for within the region, so you can deliver those solutions. So if I think of those trends, I'll call it locally, the capabilities of the firm have expanded tremendously over the last 3 years, literally from zero to where it is today over 3.5 years.
Yeah, so nice. Well, Rob, thank you for sharing all those information with us. Thank you for being here.
It was my pleasure, and look forward to doing it again.
Good.
Thank you.
And thank you for being with us in this episode of Conversa de Fundos. See you.